Hi guys, thanks everybody for tuning in. This is JC Parets. I'm founder of Eagle Bay Capital. A lot of you guys know me from the blog allstarcharts.com. Started the company back in 2012, really with the idea of really going out there, doing my own thing, managing one portfolio, through a hedge fund. And just recently in the fall, we came out with a subscription research product that can be seen at eaglebaysolutions.com. And we'll get into that at the end. Today, I wanted to kind of just get into a couple of things. I've never really done this sort of structure. We went out there over the last couple of weeks and asked different readers and different Twitter followers and StockTwits followers, people that read me on Yahoo Finance and everything like that, to submit requests and, kind of just go out there and, see what the community was looking at. And what we're going to do today is, we're really going to start with a clean slate, and there aren't any annotations on these charts. I'm literally looking at them. A lot of these names, obviously, I look at pretty frequently, but what I wanted to do in this particular case was kind of just eliminate all of previous annotations and notes, and kind of just diving in here, from kind of like a new perspective. So I think that hopefully you guys get a lot of value from it. I know I personally will for sure. Kind of just digging in from and kind of starting from scratch. So let's get right into it. I think we could just kind of go for it. So readers really contributed a nice list, and kind of impressed at kind of some of the diversification in some of the requests, from commodities to individual equities. It's not just Apple. There are some some interesting stuff that you guys requested. So right off the bat, let me just kind of explain, what we're looking at here. I like to use Japanese candlestick charts. This is what we have here. This is a 200-week moving average. 200-week moving average is very standard, 200 periods. And then down here, this is a measure of momentum. I like to use a 14-period relative strength index. A lot of people call it the RSI. This is standard for me, whether we're looking at a daily chart or a weekly chart. This is a weekly chart of SPYs, and then here's a daily chart of SPYs. Is this not coming in? I guess we can't. I guess we're gonna have to kind of just change. That's fine. I don't have a problem with that. So as you guys can tell, this is the first time I do something like this. We could just change to a daily if we want to dig down a little bit closer. Okay, that's fine. We can work with that. So that's really how I use it. So neither one is going to change. We're just going to continue to go. So oddly enough, SPY is actually one of the names that was asked by Juan Sanchez. JC, the February 4th extreme moves, previous and subsequent days, what's the best approach to profit from them? I don't know that I really understand the question. February 4th extreme move. So let's look at a daily chart of SPY, February the 4th. February the 4th, we're looking at right around here. Let's look a little bit deeper. February the 4th was right there. Kind of just like a reversal, and then it kept going. Let's go back and look at this a little bit bigger picture, and really get I think this is a great starting point from what we're trying to accomplish here. So here's a monthly chart just to get a good idea as to what we're working with here. I mean, from a structural perspective, you have a high here in 2000, a high here in 2007, and we were off to the races in 2013, broke through that, and we've never looked back. So from a structural perspective, it's very difficult to be bearish this market. Everything looks good. Now digging in a little bit deeper, here we're looking at a weekly chart. There's your former resistance levels that we've broken through. We could really draw a trend line up here, kind of see where we are, and we're holding on. I mean, that's an uptrend if you ask me. I mean, there's absolutely no doubt about it. We had a nice little whipsaw here in October, came right back. So I would keep an eye on this. If we can hold on to this, really from a structural perspective, kind of look back here, you can really see where we're at. This area here, to me, is really the big level. This support area right here, we break down below that. Let's call it the week of early February. We break below those lows, and I would start to get a lot more cautious. That's really the level to me. And then over the near term, you know, we can come up with some nice little price targets here. So, excuse me. So what I like to do is I like to take the previous correction from up here, take it all the way down, and that'll give us a target of 214 to the upside. So let's just clean this up a little bit. There's no reason to have all of these Fibonacci retracements. So this entire move from the September highs to the October lows, that's a 100% move. So I would take a 161.8% extension of that, and that takes us to about 214. We're here at 209. That looks like a good target to me. So that's I hope you guys get a pretty good idea as to kind of now the way I approach markets. I really approach them all the exact same way. So moving right along, let's take a look at GLD. Stephen LeBlanc asked, what are your thoughts on gold, please? All right, well, he said please. So let's look a little bit big picture here, kind of see where we are from a more structural perspective. Man, you know, this is a big time break. You know, there's absolutely no doubt about it. You know, we can look at these Fibonacci extensions right here, kind of come up with some downside targets. Let's just get out of this permanently. Kind of save this. Started from scratch, so all my default settings are in this particular case are off. So as you can see, you're hearing it from the horse's mouth. Actually, let me put the 261. There we go. So here we are looking at gold. So this last rally, you know, really this 103 area looks like a pretty key level. So just taking that out of the way, forget Fibonacci for just 1 second. This area to me, this former resistance down here, this resistance that we hit in the beginning of 2008, ran into it again in July, ran into it again in February of 2009, and ultimately we broke through. So this is a great example of the more times that a level is tested, the higher the likelihood that it's going to break. 1, 2, 3, 4, 5, boom, we're off to the races. So this level looks like a great area for price to catch support. In terms of the chart itself, this looks like just looks really messy. Let's look a little bit more closer, shorter term, to see what we have here. Let's close this up a little bit. So here's my problem. Here's my problem with oil. This is what I see here. Here's my problem. You have a trend line right here. Excuse me, not oil, with gold. You have a trend line here. You have a nice trend line here. And this is the one that became a problem. You see this? That became a problem. So what I see here for the most part in gold is you had former support at the summer lows of 2013. Then you had the December lows of 2013. And that was big time support. So what happened? That support held. It held again. It held again in October and then broke. And then quickly got back. So now it's just become a mess, right? We know it's a downtrend because, you know, we looked at the weekly chart and we're still in a long-term downtrend. We're below these downtrend lines as we speak. We have a downward sloping 200-day moving average. I will say that a couple of things that I do like, that so far we're still holding above this level. So I would argue that as long as we're above this level, which was support a couple of years ago, and trend line support from the October lows, this is the big line in the sand here. You know, overall, we're in a downtrend. I mean, so to fight this and getting on the long side is very, very difficult to do. If you're able to do it, good luck. I like to have the tide to my back. So that's one thing that is positive. The other thing I would say is that momentum got into overbought conditions. That's a good thing. You know, look at these oversold conditions that we were seeing. That's not good. That's characteristics of a bear market. So the fact that we're able to get up there is not necessarily a bad thing. But this is just not something I would want to be buying. I would actually prefer to short a break of this trend line. So, you know, let's call it, let's call it just below below these lows here. You know, below 114.5, something like that. I think we have a long way to go. I think looking bigger picture at the weekly chart that we were just looking at before, this area around 100 looks like a great target. And you know, speaking of momentum, not getting into overbought conditions, that's a big problem in the GLD. I don't see anything to like here in the gold. I wouldn't be a buyer. I would rather be shorting a break or fading strength. But to be a buyer in something like this, you know, that's just not for me. So let's move on. Dan is asking about the VGK. So he wants us to look at VGK. Let's go ahead and take a look at that. And this is really a representation of Europe. So bigger picture. And remember, this is dollar denominated, so you're getting hurt by the stronger dollar, which is fine. You know, we could deal with that. Let's just worry about the chart at hand. Here we have a nice uptrend line. Brief breakdown, but it's holding above it. Flat 200-week moving average. So while we're on the subject, let's get into the 200-period moving average for a second. You know, for me, sure, sometimes it serves as support and resistance. In this case, it actually has very much so. Nice resistance up here, resistance again, resistance in 2012. Then it turned into support at the end of 2012, support in 2013, and it's been support over the last year here as well. So in this particular case, we are seeing the 200 period, in this case a 200 week, turning into support and resistance. For me personally, I like to approach a moving average more so for trend recognition. You know, in this case, we have a flat 200 week, so there is no trend. The trend is flat. I tend to try to shy away from those. Flat 200 period moving averages tend to cause a lot of headaches, a lot of failed breakouts, a lot of failed breakdowns. So for me, right off the bat, looking at this bigger picture, it's just not for me because there's a lack of trend, you know, personally. But looking a little bit closer, let's see if there are any opportunities from a more tactical perspective. You know, here we are. We've got a down, you know, we've got a downward sloping 200-day moving average. Sure, we broke above this downtrend line, but this is trouble. You know, this is a lot of trouble. We've got a ton of support and resistance here, right? From the last couple of years, or for the last year and change, this was resistance, turned into support again, close to support again. Then it broke. That former support turned into resistance. These are our polarity principles. So sure enough, right here, turned into resistance. And now here we are at resistance again. Momentum's failing to hit overbought conditions. Downward sloping 200-day moving average. This is a tough buy right here. This is not something I want to be buying. If anything, I'd be fading the strength into here for those reasons I just mentioned. All right, so Susan has had stock for over a year, but screwed up calls in January, didn't have the courage to keep them till the very last day, went back and forth to this market, and knew 170 was a breakout. Any technical way? All right, let's see. So AVB, let's see, let's help Susan out here. So here we're looking at let's look a little bit bigger picture, get a better idea as to what we're seeing. So here we are. Susan is asking, you know, about these levels. Here, right off the bat, the level that stands out to me right here, that resistance that broke out, that was huge. That was a huge breakout. From a structural perspective, it doesn't get any better than that. So let's look a little bit shorter term. Man, so here's what I see. You know, nice uptrend. There's absolutely no doubt about it. Upward sloping 200-day moving average. Love that. Above resistance. Love that. Momentum getting overbought. You know, in a bullish range. There's nothing wrong with that. You got even a parallel channel. Whoops. Let's get back over here. Yeah, I mean, you know, you've got, let's see, we could take this all the way down to here. This looks like a pretty clean trend line if you ask me. You had a nice little failed breakout up here. Shouldn't be that surprising, right? After such a fast move to the upside, this is not you know, this is not, you know, out of the ordinary. You know, we're in the middle of this channel. It looks good. You know, I would be a buyer of this dip, or unless if we get some consolidation here sideways, perhaps maybe, you know, buying something like that. But overall, the structure looks great. You know, she asked specifically about a breakout. She's speaking about a breakout. 170 was a breakout. So Susan's question is down here, and you know that breakout was a failed breakout, so that's a problem. You know, I would much prefer to be a buyer down here, maybe towards this upward sloping 200-day, if it could catch up and get into this channel. This trend line looks pretty strong. You know, maybe down around 160 or something like that. That would look like a good entry point to me. So moving right along, Eric McQuinney is asking about DFS, which is Discover. Let's look a little bit bigger picture, see if we can get a nice structural perspective here. You know, this really is a monster. So I remember this was a spin-off, so it doesn't have a lot of history. I don't like this. I don't like this uptrend line breaking. That's not very good. Kind of rolled over there. So let's focus on the on a more tactical approach here. You know, especially with these with this bearish momentum right here. See this? This is what we call a bearish divergence. When you have prices making higher highs this entire time, right? Look at these higher highs. See that? And then momentum's putting in lower highs. That's a bearish divergence. We don't like to see that. So I guess it shouldn't be surprising that prices sold off. And then short term, we're below a flat 200-day moving average. That's tough. That's really tough. You know, so this looks like a big area of support and resistance historically. This area, this you know, $60 area was resistance early last year, turned into support in the summer, and then once it broke on a gap lower, you know, that breakaway gap. I mean, that's tough. So we're back here now, retesting that former support, flat 200-day. I mean, man, momentum confirming these new lows. This is a really tough buy for me. It's not anything I would touch, especially with all this overhead supply. Even if we are going to break through it, and sure, that would be a positive development, you still have a flat 200-day. That causes a lot of headaches. You know, this is going to take some time, I think, you know, for things to really, really get better. You know, this is a broken chart. There's no doubt about it. So I would want to see some time get back above this, maybe consolidate above the 200-day. But for right now, this is a no touch. There's no reason to buy this at all. I'd be fading this strength for sure. You know, even though bigger picture, it's such a nice chart, you know, short term, tough buy. It looks like a broken chart to me. So let's look at coffee. Andy is asking about coffee futures here. And then here's another good example of a flat 200-week moving average. I mean, this is tough, man. You know, and now we're rolling over. So, you know, you really want to stay away from this. Here's a great example of why we stay away from these flat 200-week moving averages or flat moving averages in general. Look at that failed breakout. You see that failed breakout and then disaster to the downside? This is characteristic of, this is very characteristic of flat moving averages. We have the same thing here. Same exact thing here. You had support right there, failed breakdown and rally, right? So now here we are, failed breakdown, rally, failed breakout, rally. This is why we stay away from 200-week moving averages that are flat. That's why we stay away from that. So let's get out of all of that. Look a little bit short term. I know the coffee chart very well. I just got stopped out of it long, so I unfortunately know it very well. But hey, that's part of the process, part of what we do. Here's a good look at that failed breakout. And by the way, speaking of failed breakouts, you know what? Speaking of failed breakouts, I think that this is a great example of a nice little consolidation. Looks like kind of like a flag, right? You had a nice little flag, pennant formation, right? This is a very bullish continuation pattern, historically speaking. This should, you know, consolidating above former supply, consolidating nicely. The fact that we broke down from what is traditionally a bullish continuation pattern says a lot. The market is speaking in this case, and sure enough, we continue to break down. I was looking at this support here, right? Coming into the year, we had a brief breakdown and then a quick rally. We took advantage of that. Then it came back, tried to buy it back, and sure enough, we got stopped out. As soon as that support was broken, all bets are off. So it looks like we're heading lower. There's no reason to be involved in this. I was looking for maybe a little bit of a mean reversion. Never took place. Momentum's in. It was a very good risk reward, so we'll take it all day. But yeah, momentum's in a bearish range. No reason to be in it. This looks like it's going a lot lower. There's no doubt about it. And again, bigger picture. I mean, with a flat 200-week moving average, this shouldn't be surprising at all. So moving right along, Mark has a question. Mark wants to know, if we move through the congestion area of 2225, what would your target be? Thanks, Mark. So here we're looking at Hertz, HTZ, and he wants to know 2225. So this area here is what he's looking at on a weekly chart, I guess, 2225. So I guess he's talking about this consolidation here. I do like the fact that we're above a slightly rising 200-day moving, 200-week moving average. That's a good thing. Momentum in a bearish range, not so much a good thing. Let's look a little bit shorter term. See what we have here. Man, again, downward sloping 200-day moving average. We have just some congestion here. I like the fact that momentum is failing to stay out of oversold conditions. That's good on these recent corrections. But again, it's not getting into overbought conditions. So momentum's not really telling us much. We're below a downward sloping 200-day moving average. Mark wants to know, if we get through the 22 to 25 area, which is basically what he's talking about here, what is my price target? Quite frankly, I wouldn't be betting that we're going to get through that area anytime soon. And even if we do with a downward sloping 200-day moving average, it's not really anything that I would want to be a part of. I mean, this looks to me like a disaster. If you buy that breakout, right? Let's just say we get through here and we do break out and start hitting 26. That has failed breakout written all over it with that downward sloping 200-day moving average. In fact, you can take the support and resistance, take it back even further. There's a lot of market memory here. If we get through that, what's my target? My target is that we fall right back down. I hate to tell you, Mark, but it just, that downward sloping 200-day and prices are below it. Not a good combination. That's not something that we want to be a part of on the long side anyway. So all right, so moving on, Harold wants to know about crude oil. The topic du jour of crude oil, and I happen to have and what in my opinion is a pretty decent roadmap to what we can see here. I look forward to seeing this video in the future, see if it actually played out. But so he wants to know, Harold wants to know my opinion on crude oil. To what extent could current rally last? Is this the bottom finally? Could you see how far could this rebound go this year? All right, so these are all assumptions that this was the bottom. I'm in the camp that we still have yet to see the bottom. I guess I'm selfishly hoping for that. I'm not involved in this market. This has been a crashing market, and there really has no reason to be involved. Number one, it's been trendless for years. So from a structural perspective, to be long crude oil really makes no sense. As soon as this pattern broke down instead of up, right? So traditionally, this symmetrical triangle is a continuation pattern by definition. And the previous trend was up, so we should have gotten a breakout, and we did, and we broke down. So that's where you got the crash. When traditional bullish patterns resolve themselves in a negative way, the market is speaking, and you got to get out of the way. And sure enough, we crashed. Now, there was obviously no reason, there was no way to know that this particular crash was going to be so dramatic. But at the same time, there was absolutely no reason to be in it in the first place. So anybody in this deserved to lose money for sure, especially with a flat 200-day breaking support. Anybody in this definitely deserved to lose money. Here's what I would love to see. We see how momentum is really just hitting extreme levels. I mean, you had momentum readings, down so low, 11 I'm seeing, 9. I mean, man, these are historic levels in terms of momentum. I would love to see one more low in price, maybe down towards 40 or something like that, and let momentum diverge positively. I find it very difficult to believe that on a new low, momentum is going to be able to get down to those levels. So what you'll have is a lower low in price, and then a higher low in terms of momentum. Maybe something like this. Maybe something like that. A higher low in momentum, and then maybe while we put in a higher low in price, and then at that point, that's when I'd want to get long, right? Because we put in a new low, momentum positively diverges, right? And then when price gets back above these lows from last month, that's the buy signal right there, and you get long right there. Which let's call around 43.5, something like that, 43.40, 43.50. You get long right there, and that's your stop. You only want to be long above those lows. So that selfishly would be my that would be the best scenario for me. If we never get that, then so be it. Then I guess I won't participate in the trade. But that's what I would be looking for as an entry point. So here we're looking at a daily chart of crude oil futures, and sure enough, we did have a slight bullish divergence. I will say that all so slightly, nothing great. But what I would love to see is a rollover, right? A rollover down to something like this, right? And you buy it right there. You buy it when it comes back. That's what I would love to see, right? So, and get momentum maybe to come down to something like around here, right? And then momentum off to the races, right? So you would put in a bullish divergence in terms of momentum, right? With a lower low in price, and you buy it right there. You buy it right there. So you see the breakdown. All the last bulls throw in the towel. Everybody gives up. And then as price starts to recover back below those lows, call it 45, something like that, you buy it right there. And that's your stop. You break back below it, all bets are off. But that's your entry. So in my opinion, this would be the best case scenario. I think it's what it would take for me to participate. So I hope that kind of gives you a decent roadmap as to what I would want to see selfishly. So here's CCJ. We're looking at uranium. So this is the big uranium stock. The Exxon Mobil of the uranium space, if there is such a thing. It would be this one, CCJ. So Dave Handy asked, very oversold, forming a base, or is this forming a base or heading lower? What do you think? Well, bigger picture, we're below a downward sloping 200-week moving average in a very strong downtrend, no doubt about it. So from a structural perspective, it's very difficult to be long this. I mean, you're below all this support as well. I guess you can make an argument you have a slight bullish divergence, but man, there's just so much overhead supply. Structurally, there's no reason to be in uranium. So let's look a little bit shorter term. And unfortunately, we have the same thing here, we're below former support, right? Momentum's still in a bearish range. We're below a downward sloping 200-day moving average. So for me, man, there's just way too much overhead supply. I mean, I just don't see it. Why force this long? You have so many beautiful, so many beautiful uptrends throughout the market and throughout the world these days that, to be looking at something like this, other than maybe just a trade. I was pointing this out on Twitter recently, how uranium was at the bottom end of this support, and we could see a pop. In fact, if you look at URA, is a good example. There we are. So there's URA, which is all uranium, the whole uranium space. Going back, you can actually look at a weekly chart would be better. CCJ represents, I believe, about 20% of this. So here's URA, and there it is at the bottom of the channel. I think we could perhaps get to the top of the channel. But other than that, maybe just a quick trade. I mean, structurally, I don't see any reason to get involved in this stuff. I think that, we're in a bull market across the board in U.S. equities. I mean, you look at a chart like the S&P 500. I mean, look at this thing. We're in a monster uptrend. And then you look at a chart like CCJ. Uranium clearly didn't get the memo that we're in a raging bull market. So do you really want to mess with something like this when the S&P looks totally different? It's not for me. So UNG is an interesting situation, totally. Here we are. First of all, I think this is an interesting look. UNG right here, right? That's key support from the 2012 lows. We briefly broke below that. And then here, we have a nice bullish divergence as well, right? So prices briefly made lower lows, higher lows in momentum. I could totally see a mean reversion here. You have a 200-week moving average up above 23, prices at 14.5. I like that. I would argue I would only want to be long above the 2012 lows. So let's look a little bit short term. I know what the chart looks like. I'm actually in the trade right now through the futures, not through the ETF. But here's key support from January. Key support in January right there, right? Get this guy out of the way. Key support in January right there. Bullish momentum divergence. Higher lows in momentum, lower lows in price. We're back above the January lows. As long as we hold above the January lows, I think we're off to the races. So this is very similar to what we're looking for in crude oil. If crude oil can make one more low, let momentum diverge positively, I think we could be off to the races. We're already seeing a similar structure in natural gas. We only want to be long if we are above the January lows. If we break back below the January lows, there's no reason to be in this trade. So I hope that clarifies some of the questions in terms of what I was discussing in crude oil. But that's the trade for natural gas. So let's look at Treasuries. So Milan is asking about Treasuries, when to go short again. This has been one of my favorite trades, since last year. This failed breakdown in bullish momentum divergence for me was the entry point. Sentiment was very extreme. You had a nice bullish divergence here. Whoops. You had a nice bullish divergence here. I mean, beautiful, right? Higher lows in momentum, right here. Lower lows in price. Boom. From failed moves come fast moves in the opposite direction. Home run. Bonds had a killer year. Now, here's what I don't like. That was a year ago. Here's what I don't like. That's a problem. See how we broke out, made new highs above the 2012 highs, and then failed miserably. See that? See how hard that is? So just like this, from failed moves come fast moves. Look how nasty this thing failed. From failed moves come fast moves. So we can't be surprised that this is getting destroyed. In fact, coming into January, I was pretty vocal about the fact that things had changed. I was out of the bond trade. Utilities and REITs were two sectors that started to roll over that are interest rate sensitive. There's no reason to have that risk on, and sure enough, we've gotten crushed. In hindsight, perhaps maybe I should have shorted Treasury bonds. I did not. But either way, we get out of the way, and that's what we have here. So from a structural perspective, there's absolutely zero reason to be long Treasury bonds. These are the TLTs, and then looking a little bit more short term, there's a good shot at what just happened. Pretty nasty, right? So yeah, there's no reason to be long. In fact, you can even make an argument here from this rally here. We also broke that. So these are the highs in October. You had more highs in December. Came back and broke out. And in theory, we were off to the races. Sure enough, we were. And we broke all that. Not only did this key form of resistance from 2012 not hold, but we weren't able to even hold the resistance from the fall. So it looks like we're still heading lower, maybe towards 120. This is not something I would want to buy. Not even if we get back above these levels, is it something I would want to buy. I would want to give it time. For me, in a lot of cases, a lot of people ask me, well, GC, what's it going to take for you to buy it? What's it going to take for you to buy it? In a lot of cases, what's it going to take? Time. I need time to pass. That's what we have here. So I hope that answers your question, Milan. Shares of Twitter. Richard is asking, should I hold on to this stock or sell now? I have heard it go back up in the near. I heard it could go back up in the near future. Well, be careful who you're listening to. Number one, opinions don't have any risk being put on the market. They're journalists or economists or analysts, and you need to be really careful with what you hear. I think there's very clear resistance right here in Twitter. Very clear. You have a downtrend line from the highs at the end of 2013 with the original spike off the IPO. Here's what I do love. I love that on the earnings a couple of weeks back, we gapped up above this resistance. I love that. I love seeing that because it really creates, what some might call an island reversal. And I love that. Now, what I would say is I don't want to really be in this until we're up above the downtrend line. Above these downtrend line, we could be in all day. I love the fact that the 200-day moving average is turning higher. Guys, I got to tell you, I really like this Twitter. I do think we break out. Is it going to be tomorrow? Do we get a little bit more time in consolidation? I don't know. But I will say that the sooner the breakout occurs, the more bullish it would be. The longer it consolidates here, the less enthusiasm I have in this particular name. I would really want to see this breakout very soon. But I do like it. Love the 200-day sloping higher. I love that momentum hit over bot conditions. So across the board, this looks great. A very positive development indeed would be a breakout above this downtrend line. And I do think we get it soon. So I hope that answers your question, Richard. We can move right on to Nick. Nick Effer is asking about GDX. So let's check out GDX. This thing, I mean, this is one of the nastiest charts on Earth, and I could say that confidently because I look at most of the charts on Earth, and this is just a mess. I mean, look at this. We're down near the lows from 2008. I mean, this is tough. You know, do you really want to be in this? Is this something you really want to have in your portfolio, considering the way the stock market is doing? You're below this downtrend line. This is a weekly chart. You're below this downtrend line. You know, sure, you got back above this support, and we're still right there. So if we can get above this downtrend line, it would confirm this potential bullish divergence that we're seeing right here. It would confirm that bullish divergence, right? You see how we have a higher low and a lower low in price. So if we can break out above that, let's call it, you know, 23 and a quarter, something like that. We break out above that, fine. You know, I would argue for maybe a little bit more of a mean reversion, or at the very least, you know, a test over here, you know, right around these highs from last summer. You know, maybe around 27, 28 bucks, something like that, if we do get above that. But there's nothing so far that suggests that we're going to see that. Here's a better look. I don't, you know, nothing so far suggests that we're going to see, you know, a breakout here. So let's look a little bit more short term. And here you are. Price ran into that flat 200-day moving average. Not a surprise. I don't like the fact that on this rally, momentum failed to hit overbought readings. That's not good. We're below the downtrend line. We're below the 200-day moving average. Momentum's still in a bearish range. Honestly, I don't see any reason to be involved with this. In fact, if GDX breaks these levels, which are the former lows, former resistance, former support from the last year and change that turned into resistance in the fourth quarter, if that fails to hold, this is going to be a big problem, because that's going to make this a giant failed breakout at this downtrend line. Momentum didn't get into a bullish range. It's going to get into oversold conditions. This could come crashing down really bad. So I would really keep an eye on this. The only thing that would make me bullish this tactically, I mean, considering structurally it's so nasty that it would take a miracle for me to get bullish tactically. You know, we would really need some time, consolidation, break out above this downtrend line, let the 200-day stop declining, start to flatten out, start to rise. And I think all of that is going to take some time. So that's what I think about GDX. I hope that that answers your question there, Nick. Moving on, we can Louis Hansel is asking about Aberdeen, which is a Chilean fund. I mean, you want to talk about some of the worst places in the world. Countries like Chile, they've got a lot of mining exposure. You know, a lot of metals mining. You know, that's just a bad place to be. It's not a coincidence that this looks the way it does. I will say that this is interesting support here, very interesting support, in fact. So we know that we're at a key support level historically speaking. So looking a little bit more short term, here's the problem. I mean, sure, we're at nice support. We got a bullish momentum divergence, but we're below this downward sloping 200-day moving average. I mean, it is so difficult to have a sustained rally when prices are below a moving average that is sloping this far down. Again, the only thing that's going to, sure, can we get a mean reversion up towards that 200-day, which is currently just under $9, and here we are at 770? Sure, that can make a great trade. Don't get me wrong, but bigger picture, I mean, I'd be fading strength into that 100%. What's going to make me more bullish here? Time. It's going to take a lot of time for this thing to flatten out. You know, this could take a very long time. So one of the risks that people don't take into account, from what I've noticed, is opportunity cost. Opportunity cost is risk also, guys. You know, something that definitely needs to be considered when you know, when putting on a position is could that money be used elsewhere? So Nick, actually, this is Nick, is a student at Fairfield University. Actually, no, Nick. I graduated from Fairfield, and you know, I'm involved with the student body in terms of finance and technical analysis. I do what I can. So nice to see Nick participating. You know, Nick is asking about Wells Fargo, consolidating ? RSI ? Well, I will say, in terms of the financials, which have been, you know, some of the worst performers, you know, some of the worst performers for a long time, Wells Fargo is definitely one that stands out as a good one. You know, took out all of this former resistance. Just look a little bit short term. see where we're at. So here's the problem that I see. You had momentum hit oversold conditions in October. That's not good. And we still haven't hit overbought conditions. So momentum is still struggling. We're above an upward sloping 200-day moving average. It looks kind of sloppy, though. You know, it's tough to say. I think it needs some time, some consolidation, maybe build a little bit of a base over the next couple of months, and then, you know, perhaps it can get going again. Now, remember, this is still in an uptrend, so we definitely want to give the bulls the benefit of the doubt. This is not something that we want to be shorting, but considering, you know, considering that momentum is not telling us good things, price is kind of choppy, you know, not really in a solid uptrend, more of a flat sideways trend, and it's in a terrible sector. You know, this is something that maybe we want to give some time. You know, I don't necessarily know that I'd want to be buying a breakout. Preferably, if it was up to me, I'd want to see some more time. You know, we got a decent uptrend line right here. So maybe we can get down to you know, 52 and change, something like that. Keep consolidating. Maybe turn this into some kind of symmetrical triangle. You know, maybe head down here, do one of these. Right? Do one of these, and then break out. Something like that, I think would be the best case scenario. It'll allow momentum. Whoops. It'll allow momentum to hit overbought conditions. You know, that would be, in my opinion, the best case scenario. So Nick, thanks for participating. I hope that answers your question. So here we're looking at the mid cap 400. Moving right along. This is Don. Don wants to know about the mid cap. I would be grateful if you discussed your process a bit. You know, for instance, assuming MDY breaks, how do you specifically time your entries? You've been one of my favorite followers for years now, and I'd really appreciate insight into the mechanics of your process. Thanks, Don. I appreciate the kind words. You know, this thing to me, I mean, obviously, I mean, what more is there to say? This thing is an absolute beast. You want to talk about bull market. So there's nothing to argue in that sense here. So let's just look a little bit shorter term, to what we've got. And I know this chart very well. I just annotated and put it on the blog recently, right around here when we were around 265. Figured we would break out. Let's see. Hold on one second, guys. So here we got some major resistance that we're taking out as we speak, right? So I like to take a Fibonacci extension from that last correction. The September to October correction was a big one. So we take a 161.8% extension of those levels, and we have hit. We're well above it, and the next price target is just above 284. As far as I'm concerned. You know, we want to only be long above these levels. I was very clear about that when I wrote on the blog, you know, what we were looking at allstarcharts.com. Figured we only wanted to be long above these levels. Sure enough, we've broken out, and that's the target, 284, 284 and a half. We start getting up there, you know, I would definitely be fading that strength. So that's really how I approach price targets when we're in uncharted territory. We've never been up at these levels at all. We've never seen it. So for me to create these targets, you know, the market tends to acknowledge these Fibonacci extensions so often, more often than not. So that's really my target. Can we get through that? Can we go higher? Absolutely. Can we roll over before we get there? Absolutely. But for me, I want to be long above the highs since last summer, and I want to be taking profits up there. That's how I would approach this market. So we've got a few more, guys. So stick with me here. I hope this is making a lot of sense. We have another precious metal request from James Shade, and this is silver. I'm just going to get right to the point in silver because we already talked about gold. Here's the problem with silver. We obviously know it's in a huge downtrend. I'll show you guys the chart real quick. But just like gold, this thing's a hot mess for a long, long time. Nothing new. But here is really what I want to focus on, is this support. This was support in the summer of 2013, support again in the fall, support again last spring, and then we broke at the end of last summer. All of that support, you see that? All of that support is now resistance, right? So on any test to get back above that support level, that's going to be a problem. And we're below a downward sloping 200-day moving average. So what's going to make me bullish on silver is time. We're going to need to get above this level. The 200-day is going to need to flatten out. And then maybe we could talk about getting long. We've got downtrend lines. I mean, you want to talk about plenty of overhead supply. I mean, this is tough, man. You know, is this really something you want to be long? Look at that. Is that something you really want to be long? I mean, that's a tough buy with so much overhead supply. It's really not for me. I would stay as far away from silver as possible. I've been pretty vocal about that, and definitely has not changed. So moving on to semiconductors. Same exact thing as the mid caps, I think. Looks very similar in nature. This is SMH. These are semiconductors. These are the chip stocks. Based on the most recent correction, a nice little consolidation. We broke out beautifully in the last couple of weeks. Nice little gap higher. 58 bucks. That's the price target. It's that simple. I'd be taking profits there. Can we go higher? Absolutely. Will we? Probably. You know, but in terms of, you know, trading and getting a good understanding as to you know, what the risk versus reward is, you know, depending on where your risk is and where you're out, that would be my reward, 58. That's where I would be getting out. So that's how I look at these markets. Momentum hanging in there pretty well, getting into overbought conditions in the fourth quarter as well, which is pretty solid. So just a couple of more is the Nikkei. This thing's this is a good one. You know, with the Japanese yen, and if you're going to be in Nikkei and you're going to be in Japanese stocks, you absolutely want to look at the Japanese yen. So here we're running into this resistance. These are Nikkei futures. And it looks like we're trying to exceed and get above the highs from 2007, which would be very impressive. So I really do like this market. I really like it a lot for a lot of reasons that I'm going to get into in just 1 second. But let's finish taking a look at this chart individually. I was just actually asked about this by a pretty popular trader. And this is what I see here. A nice downtrend line. Flat support. Right here, pretty clean. And now we're breaking out. So I think we're heading higher. And here's what I think the catalyst is going to be. This is Japanese yen. This looks like a continuation pattern to me all day. Here's the yen. They're negatively correlated, the Japanese yen and the Nikkei. See this? This looks like a continuation pattern to me. We broke. We're retesting. This thing rolls over. I think Japanese yen explodes. The Japanese Nikkei explodes to the upside. And I think that also puts a bid in U.S. equities. So if you're trading the U.S. stock market or the Japanese stock market, the yen is a very, very important chart. I think if the yen rolls over here, that's going to be very, very bullish for equities. I think risk-on environment is going to be here. So that's the one that we want to watch. And I think it's already broken, retesting successfully this week. And I think we roll over. And if I'm right, you know, that's going to be very bullish for both U.S. and Japanese equities, which obviously if U.S. and Japanese equities are doing well, you'll probably have a pretty decent underlying bid in equities around the world and a nice risk-on environment overall. If we start to rally here in the yen, I think that would be detrimental to the risk environment and risk appetite across the board, particularly in U.S. and Japanese equities. So we'll take a look at a couple more. Boeing, man, I got to tell you, I mean, this really has been a home run. I mean, you really can't draw it up any cleaner. First of all, let's go back to this area here. That was a major breakout. Let's talk about this for a second. The more times the level is tested, the higher the likelihood that it breaks. We ran into it in 2011. We ran into it in 2012. Ran into it again in early 2013. Boom, we're off to the races. The bigger the base, the higher in space. Here's a perfect example. Boom, off to the races. Now, what's happened more recently? Look how it's consolidated these gains in a nice. Prices can consolidate gains in one of two ways: sideways through time or through downside correction in price. In this case, we got it sideways through time for over a year. So this breakout, the fact that it's been so explosive to the upside, should be of no surprise at all. This is a beautiful consolidation, a beautiful base. So how do we come up with a price target? Take the high to the low, and we get a target of 162. That's the target right there. It's that simple. Momentum's in a bullish range, never getting into oversold conditions, and we're off to the races. I'd be fading it at 162. That's where I think we're going. I like this chart a lot. I mean, what's there not to like? Beautiful breakout, nice consolidation, and we're off to the races. That's where I think we're headed. 162, 163. That's where we're going. That's where I'd be fading it. So two more real quick. Bank of America. It's a popular name throughout the investment community. Whenever I say anything bad about it, people get upset, which is interesting because who cares? It's just letters and math. I see a ton of overhead supply here. Look at that. Can't make that up. Ton of overhead supply. You got momentum rolling over. Prices are making higher highs. Momentum's putting in lower highs. Not good. So let's look a little bit more short term. We know that there's overhead supply here. And you got a flat 200-day moving average. So, this is a headache waiting to happen. I mean, it is a headache, obviously. So, I mean, here's a great example as to, actually, I'm glad that we're talking about this because look at this. This is a perfect example, guys, as to why we stay away from flat 200-day moving averages. You have prices, you have key resistance here from last spring. You have a sell-off, fine, you get a rally all the way back to it. And then what happens? Whoops. Look at that. See that? How we briefly broke out and then completely failed miserably and the stock got destroyed? This is textbook. This is a characteristic of a flat 200-day moving average. This is what happens. This is why we stay away from these, because this is exactly what we should expect when we have this sort of environment, a trendless environment. It causes headaches. Who needs this stuff, right? So I would argue that, okay, going forward, I would argue that some further consolidation above the 200-day, slightly sloping up, fine. Another retest of this level of 18 would be very positive because that would be the third test. And again, the more times the level is tested, the higher the likelihood that it breaks. So I would argue that another retest would be successful, and we could probably get bullish on maybe the fourth retest and then a breakout after that. But again, it's going to need some time, man. Flat 200-day moving average, that's not pretty. That's tough to trade. I think it's a good example. So Prawn, I really appreciate you bringing this up. I don't know if you did it on purpose because it's a flat 200-day, but a great example from an educational perspective as to really why we stay away from these. So just last one. Here we're looking at a daily chart of Pfizer. Mark wants to know would I buy this one? So I really like this one a lot in the fall. I'll tell you why. I mean, you want to talk about trend channels. I mean, they don't get cleaner than this, right? I mean, they really don't get cleaner than that. Parallel channels, stocks trading in between that, right? Here's what I loved. Man, did I love this. I remember this like it was yesterday. Look at that failed breakdown and bullish momentum divergence. Look at this. You got momentum putting in higher lows, right? Higher lows in momentum, bullish momentum divergence. You have a breakdown below the summer lows. Here's your failed breakdown. Here's your recovery. That's where you buy it, right there. You buy it right there. So if it breaks back below these lows, all bets are off. So that's your risk. And then obviously you were right, and that's your price target. Sure enough, so that's the target. We consolidated and then broke out again, right? So that's what we want to see. This is the kind of stuff that we want to see. This is such a well-behaved stock. I always say this about Pfizer. Very well-behaved, but if I'm not mistaken, I'm fairly certain we already hit the target. Nope, we're still not there yet. 36 and change, that's where we're headed. That's my price target. Everybody makes their price targets different ways. I like this. I would be a buyer of pullbacks towards 33. Here's what I don't like. I don't like this bearish momentum divergence at the new highs. I don't love that. So up here, would I be buying it? No, but I'd probably be buying a pullback down to 33 at this form of resistance. See this right here? At this form of resistance. That's probably somewhere where I'd be buying it. And then I would be fading around 36 and a half. So that's where we're at, guys. So I really appreciate you guys sticking through this. Just want to show you a couple of things real quick. For you guys, if you guys want to follow me, I'm writing here on allstarcharts.com constantly. Here I'm talking about internet stocks earlier in the week or last week, if I'm not mistaken, last week. Allstarcharts.com. I'm blogging there constantly. Please feel free to check that out. If you're interested in our research products, we recently launched a subscription research product last fall. EagleBaySolutions.com. Eagle Bay Capital is the company that I own, and Eagle Bay Solutions is a wholly owned subsidiary of that. And, you know, we have 5 different packages, everything from commodities and currencies to all 30 Dow components, all of the global markets, all over, you know, from the Nikkei to Latin America, to Africa, Europe, Middle East, Canada, all over the place. These packages are both, all of these packages, including the US sectors and subsectors, all the major US averages. These are all 5 of our products. Please feel free to browse eaglebaysolutions.com. You know, every single one of our packages comes weekly. There's 4 packages a month. And then every single package comes with all of the charts on both daily and weekly timeframes, just like we did here today. Looking at momentum, looking at moving averages, looking at price targets, support and resistance levels. That's really what this is all about. And this is my homework, guys. You know, I manage money, you know, for investors, and the homework that I do, you know, you guys, you know, feel free to take it. You know, we'll email it to you. You know, at the end of the day, it's up to you to execute, just like it's up to me to execute. But at least you get access to my homework. And for anybody out there, you know, looking for money management services, you know, feel free, go to allstarcharts.com, then go to the Manage Assets tab right here, and you could go ahead and fill out the form. And, you know, if you have any questions, you know, I can always be reached at info@eaglebaycapital.com. You know, and again, you know, just as a refresher, you know, again, I really appreciate you guys listening to this. I hope I brought some value. You know, you guys know me through allstarcharts.com. Follow me on Twitter and StockTwits at allstarcharts. I'm also a contributor to Yahoo Finance, so you can find me there as well. And if you have any questions, guys, by all means, please feel free to email me at info@eaglebaycapital.com. Thanks a lot.